Okay, today we're going to be talking about choppy forex markets, and market isn't always trending. Sometimes it's choppy, and you've got to learn how to deal with that as a forex trader. This is one of the lessons in our 35 lessons from forexearlywarning.com. So sometimes the market is trending, and trading a trending market is easier sometimes than trading a choppy market. Sometimes the market is ranging, and I'll show you how to identify those types of market too. But when you get into a choppy market, and this is like an H4 time frame, and if you see a currency pair that's behaving like this, you can take it down to like the M30 time frame or something. You just see that pair spiking up and down, in this case not even moving at all, and it can get pretty treacherous. And what you have to do is not trade or move on to another pair or another currency group. We'll go through some of those specifics here in a second. But sometimes the forex market really isn't choppy, but it's just in very tight ranges. And if you move into a market like that, where the market is not really choppy, but in a tight ranging market, that's also bad. Where the ranges and when it's cycling up and down, you got like it's 75 pips or something like that. It's just not enough to trade or enough to mess with. So sometimes the market is ranging and it's very smooth. If you click on that link right there, ranging forex markets that are smooth are good. This article will tell you all about that. Like on this pair, for example, you can see even on the H1 time frame, you got a pretty wide range of about 175 pips here. This is the USD CAD. And you can trade pairs that are like this, but not pairs that are just excessively choppy like this. So what causes a choppy market? There's several potential reasons why the market could be choppy. If both currencies are strong or both currencies are weak, that's going to make the market choppy. So in this case, this is the Aussie dollar against the yen. If the Aussie dollar is strong and the yen is strong, you create choppiness. If the Aussie dollar is weak and the Japanese yen is also weak, it's going to create choppiness. You need for one to be strong and one to be neutral or weak, or the other one to be weak and the other one to be neutral or strong, to create the movement cycles. Okay, so that's one way, is you get into a tug of war. The other way is that if you have an important news driver, for example, if the US dollar has interest rate news that's coming up in a couple of days, sometimes the market just stalls and goes sideways for a couple of days, awaiting the outcome of the news. Okay. Or, for example, another group of pairs might become choppy or just go sideways ahead of an interest rate news driver. It can happen with any currency on all 8 currencies that we trade at Forex Early Warning. And really sometimes the market can just not be moving. But if the volatility index for the S&P 500 is very close to the low end of the total range, sometimes you can get into a choppy market that way. Where the market is not choppy, it's just not moving. So the best way to identify a choppy market is with multiple time frame analysis. You have to set up all 28 pairs, and you have to use our market analysis spreadsheet. You can click on those links right there and get them. And if you want to learn how to analyze the market thoroughly using multiple time frame analysis, just click on that link there. We also have a market analysis spreadsheet where you can fill out a spreadsheet, and it tells you what currencies are strong and weak and what currency pairs are trending. Excellent tools. So how do choppy markets start? Well, the market goes from trending to ranging. And so this is an example D1 time frame on the euro against the New Zealand dollar. So you can see you have your trending period where the pair is trending down, and then it's all of a sudden it starts to consolidate. So it goes into a consolidation period. And look, this is a 6 or 7 day period here where it's choppy. Well, it usually happens after a trending period and you go into a consolidation period. So this means, since this is the euro against the New Zealand dollar, this means that either all of the euro pairs or all of the New Zealand dollar pairs are now choppy. That's 7 pairs out of 28 that we trade. So this pair moved down for about 15 days, but it became choppy for about a week. This is the daily time frame. Each bar is 1 day. So that's a 1 week period that this pair went choppy. Okay. So that's a long time. And so if you get a whole bunch of pairs doing this at the same time, if too many pairs are consolidating at once, that's going to turn the market choppy. If this was the W1 time frame and it came down for about 15 weeks, this would be a choppy period of about 7 weeks. That's a long period of time. Okay. So, and if you want to know if a choppy market is coming to an end, you know, you'll see a pair that's bouncing around in a range, and then it finally breaks out of the range. You see it, you have a resistance level here, and then it finally breaks out, and you can see it's headed up to probably this level here. This is the USD yen. So you have this choppy period here, where it's basically just consolidating, and eventually it breaks out, and now you have a chance to get back up here to 113 from 111. So that's a little over 200 pips there, because this is the D1 time frame. It's a bigger time frame. The 250 pips of upside, actually. So if you get into a choppy period, if you get into a period that's like this, or if you get into a period like this, here's some suggestions. You might want to, the first thing, you know, I mean, you have several choices for how to approach a choppy market. One is just to not trade at all, or another one is to trade significantly less lots per trade. If you trade about 5 mini lots per trade, you know, you may, in a trending market, you might only want to trade 1 or 2 mini lots until the market starts trending and breaking out again. If you do trade a choppy forex market, you should be able to exit the trades sooner, and you should be able to, and you should be willing to scale out lots faster. So you're more of an intraday trading style or day trader. If you want to learn more about the different trading styles, you can click on that link right there. Learn about intraday trading styles, or learn about day trading, learn about swing trading. And if you want to learn how to scale out lots, we have another link right there. Send you to that page. Show you our money management techniques. So if you, let's say in a choppy market, you choose to trade 2 mini lots, you want to scale out lots much faster. Scale out 1 lot when you're at a smaller profit level. And also in a choppy market, any trades that you do take should be accompanied by very strong entry signals. Here's an example of the Canadian dollar being weak on all 7 pairs. Even in a choppy market, you're going to get pretty good movement. That's darn good movement right there for the EuroCAD. So you're seeing that the Canadian dollar is weak on 7 out of 7 pairs. And this is our tool that's called the Forex Heat Map. This is the Forex Heat Map. And it's this is just a screenshot of the Canadian dollar pairs, but it has 8 major currencies on there, including the Canadian dollar and all these other currencies you see here: Aussie dollar, Euro, USD. If you get a strong signal for Canadian dollar weakness, you can probably do some short-term trading even in a choppy market. So this is an example of buying a Euro CAD buy signal or a CAD Swiss sell signal. So sometimes you get into a choppy market and you got to learn how to trade it. But it's really entirely normal. If you have about 5 or 6 pairs that are choppy out of the 28 that we trade, that's pretty normal. There's always a few pairs that are choppy. But if you start doing multiple time frame analysis on the market and you start getting into 15 or 20 pairs that are choppy, it starts to affect everything. If you get way too many pairs that are choppy out of the 28 total pairs, like you have 20 or more pairs that are choppy, you're going to have to start to realize that that's going to impact pretty much every trade, even on pairs that don't even look like they're choppy, because you got too many currencies that are having a tug of war and creating the choppiness, like the example we showed you at the beginning, the example of the tug of war. When one currency is strong and the other one is strong on the same pair, or one currency is weak and the other one is weak, and you just have no net movement. So definitely want to always be aware. Sometimes traders say, well, gee, I was demo trading and everything worked fine, and then I started trading real money and I started getting into stop outs. Well, the market changed and you probably weren't running your multiple time frame analysis every day to figure out what was going on with the market. So determining when the market transitions from choppy to back into a trending market is pretty important, and you can do that with multiple time frame analysis. So choppy markets, when the market is trending, it's easier to trade. When the market is ranging in wide ranges and nice smooth ranges, you can trade that market too. When the market gets choppy, you have to make some adjustments. Not trade at all, trade less lots, and then start monitoring the market for when it breaks out again. If you see real strong signals like this in a choppy market, it's a good indication that the market is starting to move in a direction again. So if the market is choppy, then you still have a job to do, and that's to wait for the market to start breaking out again. That's the most important thing you can do, is to not miss it when it breaks back out again. So this is how to identify a choppy forex market and how to trade it. And this is in our 35 lessons from forexearlywarning.com.